once you've figured out how to classify financial instruments, measurement becomes a whole lot easier. One of the great things about the new classifications is that their names tell you how to measure them. There's four main things you need to know how to measure and account for with financial instruments: initial value, transaction costs, interest, and ongoing value. Firstly, initial value. It's always fair value. You've already covered how fair value is determined in Unit 6. This will generally be the amount you paid for the financial asset, or the amount you received for the financial liability. Secondly, transaction costs. This is costs like brokerage or initial fees paid. If the financial asset or liability is classified as fair value through a P&L, these will be expensed. If it is classified as amortised cost or fair value through other comprehensive income, then you include them in the initial cost of the asset or liability. Something to remember here is that transaction costs are always an outflow. So that means they increase the initial value of an asset, so increase the cost, but reduce the initial value of a liability, so they reduce the amount you've received. Thirdly, interest. This is measured using the effective interest method. This is a method that exactly discounts all the future cash flows of the financial instrument to the carrying amount when you initially recognised it. If there are no transaction costs, then it will probably be the same as the interest rate paid or received. Lastly, ongoing value. Assets and liabilities classified as amortised cost are measured at their amortised cost on an ongoing basis. This is their initial value, plus or minus any principal repayments, plus or minus interest using the effective interest method. Other assets and liabilities are measured at fair value. Where the revaluation gains or losses are recognised depends on how you classified the instrument. If it was classified as fair value through other comprehensive income, then gains or losses are recognised in other comprehensive income. If it was classified as fair value through P&L, then, as the name suggests, gains or losses are recognised in P&L. Let's use an example to work through how you would measure a financial asset. In the classification video, we introduced Pullman Limited, which purchased a $1 million corporate bond on the 1st of January 20X5 that pays interest at 5% on the 31st of December each year and matures on the 31st of December 20X7. There's some more information we need to know about the bond. Firstly, Pullman paid $1,500 in transaction costs when it initially acquired the bond, which means the effective interest rate is not 5%, but 4.945%. In an assessment or an exam question, we will always give you the effective interest rate. So let's look at how you would measure the bond in Pullman's accounting records. In the previous video, we determined that the bond would be classified as amortised cost. We'll look at that, and then also look at what would happen if it was classified differently. Firstly, its initial measurement. The fair value of the bond is the amount Pullman paid for it, which is $1 million. Pullman also paid transaction costs of $1,500. The bond is classified as amortised cost, so that means we include the transaction costs as part of the initial cost of the bond. The journal entry for this would be to debit the bond value on the statement of financial position as $1,001,500 and credit cash for the same amount. Now we need to work out how to account for it during its life. The first thing we need to do is calculate what interest should be recognised. To do that, you need to set up a table that looks like this. This will help you calculate the interest to be recognised each year, as well as what the amortised cost of the asset will be. We've calculated already what the initial carrying amount of the asset is, so we filled that in for the 1st of January 20X5. On 31st of December of that year, we receive interest on the bond at 5% on the face value of $1 million. We then calculate the interest we've earned using the effective interest method by applying that rate against the opening carrying value. This gives us interest earned of $49,524. We can now calculate the carrying amount of the asset at 31 December. There have been no principal repayments during the year, so we take the opening carrying amount, deduct interest received, and add interest earned. This gives us a carrying amount of $1,001,024. Some journal entries here will show you how this works. The journal for recognising the interest received is to debit cash and credit the bond for $50,000. We don't credit P&L here because this is not the amount of interest we want to recognise as earned. We then prepare a journal to recognise the amount of interest we have calculated we have earned, $49,524. So here we debit the bond and credit interest received for $49,524. The net effect of these two journals is to reduce the value of the bond by $476 to $1,001,024. We carry on the same calculations and journal entries in the second year, 20x6, and end up with a carrying amount of $1,525. In the last year of the bond, the interest calculations and journal entries will give us a carrying amount of $1 million, exactly the amount we know we have to repay at the end of the bond's life. So in this year, we also include the principal repayment, which brings the bond value down to zero. You can see from all this that the interest earned on the bond is lower than the interest received by exactly $1,500. The effect of using the effective interest method is to amortise the initial transaction costs over the life of the bond instead of recognising them up front. So that's how you account for the bond if it is classified as measured at amortised cost. What happens if it's classified differently? Firstly, let's look at fair value through other comprehensive income. Most of the accounting would be the same as amortised cost. The initial recognition of the cost of the bond would be the same, as would the calculation of interest earned and the journal entries for this. The difference is that for fair value through other comprehensive income instruments, Pullman will need to revalue the bond each year to its fair value and record this movement in other comprehensive income. Let's say the fair value of the bond at 31 December 20x5 is $990,000. Compared to the carrying value of the bond at that date, this is a reduction of $11,024. The journal for this will be to debit fair value through other comprehensive income reserve in other comprehensive income and credit the bond for $11,024. The fair value through other comprehensive income reserve will be displayed in the statement of comprehensive income as an item that may be reclassified subsequently to profit or loss. Now, this journal doesn't impact on your effective interest calculations going forward. It just means that the bond is now recorded in the statement of financial position at fair value. When the bond is finally repaid on the 31st of December 20x7, any net amount remaining in the fair value through other comprehensive income reserve relating to this asset will be transferred to P&L. Finally, let's look at what would happen if the bond had been classified as fair value through profit or loss. The first thing that changes is how Pullman accounts for transaction costs. In this case, these costs would be expensed. Here's the journal entry. You can see that we recognise the $1,500 of transaction costs in P&L rather than in the cost of the bond. This will mean that the effective interest rate calculation will be different, as there are no transaction costs recognised in the initial carrying amount of the asset. The effective interest rate in this case will be the same as the interest rate on the bond, 5%. Here's the new journals and the carrying amount. The final difference will be where changes in fair value are recognised. For fair value through profit and loss instruments, changes in fair value are recognised in P&L. So if the fair value of the bond was $990,000 at 31 December 20x5, the journal would be to debit loss on revalue of investment in P&L and credit the bond for $10,000. You will see that the journal amount is different because the carrying amount of the bond at 31 December before the revaluation was $1 million. So that's an overview of how to account for financial assets. I hope you found it helpful.